Silvergate was one of the first banks to get involved with crypto. Now it says it's voluntarily winding down operations. La Jolla's Silvergate Bank will be closing because of crypto losses.
Today that reminded so many of us of the unsettling times that came with those banking failures back in 2008. Tonight, a bank has been seized by state and federal regulators. This is the biggest bank failure since 2008, and this evening, so many customers demanding to know, where is our money? Now, this bank, the Silicon Valley Bank, a favorite of the tech industry. Customers today rushing to withdraw their money, finding branch offices closed and ATMs not working.
Onto a developing story after the collapse of Silicon Valley Bank on Friday. Another bank just shut down. Regulators today abruptly closed Signature Bank. It has offices throughout New York and Connecticut. CBS 2's Lisa Rosner has more on how the feds are responding to protect deposits.
Citing systemic risk, regulators shut down Signature Bank Sunday. The company told us no comment.
Following more troubling financial news, this time involving one of Europe's largest banks. Credit Suisse shares fell 24% today over funding concerns and the discovery of material weaknesses in its business.
The worry has been growing since Friday. In fact, there were multiple social media posts over the weekend showing people lining up at First Republic branches in Southern California to withdraw their money.
To Steve Leisman, who has breaking news on the Fed. Steve.
Thank you, Morgan. We have the Fed's balance sheet for the week ending this past Wednesday, and it is up by $297 billion as a result of a couple failed banks, as a result of borrowing at the discount window. Borrowing at the discount window rose by $148.2 billion. And then this new program that the Fed launched on Sunday in order to provide par value for high-quality collateral for the banks, it rose by first-time borrowing. It's $11.9 billion was borrowed.
Well, markets did rally today. We are seeing them close higher across the board. In Toronto, the TSX up by nearly 1%. The S&P 500, the broad index in the U.S. up 1.75%, and the Nasdaq closing by 2.5% higher. So a fairly strong day for North American markets.
All right. Today is Thursday, March 16th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Where do we begin? How about the stock market rally today? Yep, you heard that right. You might be listening right now and saying, what market rally? What are you talking about, Maverick? What if I told you that we have at least 3 banks in this country that already blew up? And we have a few more in the way. What if I told you that giant banks overseas are also blowing up? What if I told you that commercial real estate entities are flashing red warning signs? They're about to blow up too. What if I told you on top of that we have an inflation problem and inflation is getting out of hand? What if I told you that the Federal Reserve is combating this inflation by raising rates higher? You would say there is absolutely no way the stock market will move higher, at least impulsively higher. But this is what we got today. And I say a few more bank blowups and we'll be at all-time highs, baby. And maybe sprinkle a little layoffs on top of that, mass layoffs. They have to be mass, not just the regular ones. Have to be 1,000 plus. And we'll make new all-time highs. Easy. You know why? Because the stock market is a cocaine addict. What is the cocaine, Maverick? It's the Fed's liquidity. And we are now at the stage where we're conditioned for over 15 years now that asset prices don't matter, that the fundamentals of the underlying securities, the companies, that doesn't matter at all. We buy stocks the same way we bet on horses. There are no fundamentals at all, whatever you feel like. And this environment in the stock market was encouraged and born by the Federal Reserve policy of quantitative easing. And we are now, of course, after 15 years of being addicts to the Fed's quantitative easing, it is really hard to move on. It is really hard to accept reality that was the past, and we have to be sober in the present, most importantly in the future. So what happens, you see the market, of course, every time we have bad news, banks blowing up, layoffs, recessionary news, we see the stock market blasting higher. And the reason behind that is the market assumes that the more bad news we have in the economy, the more discouraged the Fed will be in the fight against inflation. The more pressure the Fed will feel to end the fight against inflation and back off from raising interest rates. Raising interest rates higher is the number one enemy for the stock market. Why is that? Because when rates go higher, all of a sudden the valuations in the equities market don't make sense at all. The valuations for over 15 years now don't reflect the fundamentals of these companies at all. You raise rates, you end quantitative easing, all of a sudden all of these valuations have to come down to reality. And that means a stock market crash. But if you're telling me that we have a lot of bad news in the economy that will force the Fed to back off, then isn't that good news to keep the party going on in the equities market? And this is the thinking right now. Although, and I love this post from the viewer, we have a lot of divergences right now. Certain corners of the equities market, certainly certain corners of the economy and commodities are actually believing that we're no longer in quantitative easing. We are in quantitative tightening. We are indeed moving into a recession right now. Listen to this. The current situation, number one, tech stocks up like we avoided a recession. 2, oil prices down like we are in a recession. 3, regional banks down like the banking system collapsed or we are in a depression. 4, big banks up like the banking system is fine. 5, bonds up like the system is collapsing. Really chaos. Absolutely right. Amen. All of this will be sorted out, folks. We have 2 themes, actually 3 going on right now. And we talked about this ad nauseum in this channel. We have the expansion theme, which was ongoing in 2020 and 21 under the bubble mania. And this is known as the expansion theme, in which technology leads the way. The growth stocks for companies with no profits, but a lot of growth in revenues, these are the kind of stocks that lead the way under the expansion theme. Then we have the inflation theme, in which commodities, value stocks, oil, consumer staples lead the way. And that theme was dominant back in 22. Then we have the recession theme, which we are expecting in 23, in which we see gold, bonds, utilities, healthcare, food, fast food, packaged food, anything food related, tobacco, alcohol, smoking. These kind of stocks tend to lead the way under a recession theme. Now we have the market all over the place. Some moving into the recession theme, some stuck in the inflation theme, and of course the delusion in the tech cohort, in the RKK types, the high growth, no profit companies are now in the expansion theme. So the market is all over the place because we have different market participants and they think differently. You and I might think we have to move on to the recession theme. Others believe that no, the Fed will back off. This is 2018 all over again, and here we go. And we have to move to the expansion theme instead. Buy technology right now. Buy the non-profit, high growth kind of stock. But all of this will be sorted out. Unfortunately, we could have sorted this long time ago. If we had a decisive Fed, clear, strong leadership that paves the way with no doubt at all. But unfortunately, we talked about this for a long time in this channel. We have a weak Federal Reserve led by Chicken Powell, and therefore you're seeing this chaos. And it is really hard to trade the stock market in this kind of chaos. You're better off stepping on the sidelines, watching the shit show, and then trade based on extremes. Extreme readings in the upside, extreme readings in the downside. We see both going on right now. If you look at an indicator called the RSI, the Relative Strength Index, for example, in the technology cohort, we see extremely overstretched readings. In banks, for example, we see extremely oversold, quote-unquote, readings. All of these divergences, folks, will be sorted out. And they will be sorted out in the next FOMC meeting, which is coming out next week. In the meantime, it is worth visiting the bulls versus the bears. What are the arguments here? When it comes to the bulls, the argument has been it's either we have a Fed pivot, the economy is being damaged too much, inflation is going down rapidly, and the Fed will have to pivot, and higher we go in the stock market again. And this was the thinking in the beginning of this year. But then we got data of hot inflation, retail sales, jobs, wages, CPI, PPI, PCE, all of them. So the bulls shifted to the other theory that look, the Fed is tightening saying they're raising rates, but the economy is not being damaged, and therefore we have soft landing coming. This is the delusion of the bulls. They shift from two themes that are absolutely unrelated to one another. Now that we have all of these bank failures, they went back to the pivot theme. Oh, the economy is so bad, banks are failing, the Fed will have to pivot, and this is good for stocks. On the other hand, the bears have been consistent because they had one theory, which is the natural evolution of any inflation cycle is a recession. Recession is the cure for any inflation problem. In the episode we had back in the 90s, in the 2000s, in the 70s, all the way back to the 20s, every time we had a major inflation cycle, it ended in a recession. The only problem is how fast you want to get to that recession. If the Fed tightens and does the job, no hesitation at all, we go straight in line all the way to the recession. But if the Fed makes a mistake and they choke, they back off, they get scared, or they declare victory prematurely as they did in the last FOMC, then we have a Fed mistake. And this mistake will cause inflation to rebound, so we have to take a detour all the way to the recession, because later on the Fed will have to come back, do the job, finish the job, and lead us all the way to the recession. That is the inevitable destination after all. The only problem is when we do that, we're going to exit the inflation rebound route detour deep into the recession, rather than moving into it gradually, which in doing so, you can prepare for it. You can see it coming. So with that understanding out of the way, the arguments of the bulls versus the bears, and the conflict that's going on in the themes in the stock market, let's move on to the main topic of tonight's video. And here it is, in focus tonight. Hubris. This is what's going on in the market right now. But let's take it one step at a time. Overnight, we got the news that Credit Suisse is being bailed out. Surprise, surprise. The SMB, the Swiss National Bank, extended $54 billion lifeline to Credit Suisse. Problem solved. Or kicking the can down the road, and then we're going to revisit this once again. And of course, the CEO of Credit Suisse came out and said that the bank liquidity basis is very, very strong. If it is strong, you would have said the bank's liquidity is strong. You don't need very, and another one, very. That's how you know you're bullshitting. When you go buy a used car, for example, all what the dealer has to say, oh, this is a good car. Oh, this is a very, very good car. Then you buy it, you hit the highway. The moment you go over 60, the whole car blows up. And then we got the news from the ECB, and Madame Lagarde, to my surprise, to everybody's surprise, she actually walked the walk and did the 50 basis points. And of course, now the conversation becomes, what will the Fed do? But a lot of critics said that Lagarde maybe is tone deaf. She's not seeing what's going on with Credit Suisse. Yeah, we had the problem with Credit Suisse for a long time. Who cares? What really matters is, look at, for example, German inflation. Nominal wages, lagging inflation. And when you put two and two together, real wages are down 5%. We have a lot of German viewers, and unfortunately, your paycheck is down 5%. You're losing to inflation even more than Americans. We're down 3% now. You're down about 5%. This cannot continue. Central banks must finish the job. And Lagarde, she's lagging to begin with. She has a lot of catching up to do, so she did the 50. And I say that Jerome Powell needs to stop being a pussy and learn from Lagarde. We should not surrender the fight against inflation because of stupid entities that has been in trouble for a long time, or because of failure of risk management by greedy CEOs. Pausing because of this will be a lethal mistake by the Fed. It will cost them a lot, or I should say, it will cost us a lot. The Federal Reserve criminals will not lose their jobs. We are going to lose our jobs. And of course, after the ECB's move, now we're expecting 25 basis points. This is becoming the consensus with about 82% in the odds. 18% for a pause, no odds at all for 50 basis points. And of course, when the market looks at yields and interest rates down, when the market is under the assumption that the Fed is now scared because we have a bunch of bank failures and they're going to back off from the fight against inflation, they're going to stop raising rates, immediately the floodgates open for risk on. Buying the shittiest stocks with no profits at all, growth companies, quote unquote, with absurd valuations. Immediately, we saw a massive inflow, $397 million on Tuesday alone into the RKK fund, which is for Tesla witch Cathie Wood. Is this a good sign if you're the Federal Reserve looking at this? Are you seeing any signs that merits a pause? Yes, we have bank failures, but you know, looking at this as a leading indicator, the moment you pause, Jerome Powell, we will see the most insane mania you've ever seen in the stock market. We will go back to all-time highs in the Qs in lightning speed. And of course, we all know that there is no justification at all for these stocks to be trading at these levels right now, never mind all-time highs. But again, when you have the coked up mentality, it's not about the fundamentals. It's all about the cocaine. If the Fed gonna stop tightening, the assumption will become, okay, look, they bluffed, then they paused. Next thing you know, they're gonna start cutting and re-stimulating the market with cocaine. And of course, the worst enemy for this kind of thinking is any good news. Because good news means more inflation, which means that the Fed cannot pause. Today we got some good news in the economy. Jobless claims went down to 192,000, which is supposed to be good news, but stock market futures took a leg down when this news came out. It is an insane mentality. Good news, bad news, good news, unbelievable. We know that the fight against inflation is not over. So why would the Fed surrender prematurely? The New York Fed's own model is finding inflation pressures more persistent than thought. But of course, the argument by the bulls and the robots, because that's who's actually buying the stock market right now, we're seeing inflation going down, Maverick. What are you talking about? Look at import prices, for example. The question becomes, are import prices going down for the good reasons, meaning supplies becoming more ample, the insane demand is slowing down, or are we seeing these prices going down because demand is going down for the wrong reasons? Because folks are more indebted right now. They're paying more at the grocery store. They're paying more at the gas pump. They're paying more for utility bills. They're paying more for child care. They're paying more for housing and rents. And they can no longer afford to buy all of this crap from overseas. The cars, the washing machines. Maybe this is why import prices are going down. But here's the problem. I've been saying that the economy is right now in stagflation. What is stagflation, Maverick? The pace of economic activity moving down into recession-like territory, while inflation sticking higher. And today, the Philly Fed Manufacturing Index proved exactly that. The headline reading is now in recession territory. When we look at the index, all in all, new orders down, but prices paid, prices received, that actually moved higher. So the pace of economic activities, new orders, that's down, but prices are moving higher, both paid and received. Now, the other question that the viewers might have is, this economy is confusing, Maverick. We know you say it is stagflation, pace of economic activity is moving down, but prices are sticking higher. Okay, but how do you explain what's going on in the jobs and the housing market? These two seem to be okay. If anything, the demand is really good. When it comes to housing, every time mortgage rates go down, the mania resumes. The demand is hot on housing. The demand for jobs and employees is also hot. Companies can't stop hiring. Forget about the tech companies. Other cyclical sides of the economy continue to hire. The answer to that is we have a shortage in housing, and that's not going to be resolved anytime soon. It takes a long time to build these houses, and for now, if folks bought homes using a 3% fixed rate mortgage, they're not going to get out of it. They're not going to sell, so the supply is not here. When it comes to the jobs market, it's the same thing. If business is going right now, even if the economy is slowing, you need employees. We can't find employees, specifically in the low skilled. A lot of folks attribute this to immigration, etc. Who knows? But we have a shortage in labor, and these two, traditionally speaking, happen to be the last blocks to fall. Employers don't like to fire employees unless it is absolutely clear that we're heading into a recession and they no longer need these employees. They need to cut costs. When it comes to homes, you're not going to get out of your home unless you're really desperate, unless the home equity value collapses, or unless you lose your job and you can no longer pay the mortgage. And then you get out. And therefore, we see jobs and housing holding on right now and actually moving higher. But they will fall. The economy, little by little, falling into a recession while inflation continues to stick higher. And therefore, this stagflation crisis will continue. And if the Fed backs off right now, mortgage rates will go down. The demand for housing will go absolutely bananas. We will see an insane mania in the stock market. This will increase the demand across the economy because of the wealth impact. We will see inflation exploding higher. In the meantime, the underlying economic conditions of the economy will continue to deteriorate. So the stagflation crisis will become even more bold and measurable among the American consumer. And of course, part of this stagflation crisis is bank failures, because the underlying economy is deteriorating, so they can no longer make money from loans as they used to before. On the other hand, we have inflation sticking, so the Fed is raising rates, and as rates go higher, so is the risk for banks. Now that we know they were not prepared for rates to go higher, therefore they continue to blow up. We are becoming a mockery, folks, a laughing stock. Even the Russian Kremlin is saying no risk to Russia from failure of SV Bank in the US. And of course, they're trolling us. Putin comes out and says that Russia is so cut off from the international financial system that we think Western sanctions insured the country against the banking crisis. Again, what an embarrassment. Our leaders are absolute geniuses, aren't they? We became a laughing stock. And the black comedy continues. We talked about SVB going down, Silvergate Bank going down, Signature Bank going down, and of course, we've been talking in this channel about it's just a matter of time before California's First Republic Bank goes bust. Today, the stock was down big in the morning. We got the news that we have JP Morgan and Morgan Stanley thinking about some sort of a bailout, some sort of a rescue package, and immediately the stock market and all of these bank stocks moved higher. And then we got the details that it is a group of 11 banks, including JP Morgan and Morgan Stanley, injected about $30 billion plus as deposits, uninsured deposits, into Republic Bank. Now, what does that mean? If you happen to be a depositor at First Republic Bank and you're freaking out, you want to take your money out of the bank, before, as customers took their money out, the bank became closer and closer to the inevitable destination of blowing up. But with this injection, it gives a cushion for the bank that more folks can take their money out without getting the bank to this threshold from which it blows up. But how long will this cushion last? That's number one. Number two, the crooks at JP Morgan, they're not stupid. They know exactly what they're doing. They're giving First Republic Bank all of these billions of dollars in deposits. Then the customers of FRB, they take their money out of that bank and deposit it in JP Morgan instead. So the money is just going to rotate from JP Morgan to First Republic Bank all the way back to JP Morgan again. But in the meantime, they're going to cash in an interest rate, a fee. You see how smart these criminals are? And speaking of criminals, maybe the extension of this deposit is to allow the CEO and his cronies to get out, to cash out and get out of the bank. Because after the bell, of course, they waited till after the bell. We get the news, surprise, surprise, of course, as we've heard with SVB, the executives of First Republic Bank sold millions of dollars worth of company stock in the 2 months before the bank plummeted. The moral of the story, folks, they all knew. All of them, all of these bank executives, they knew ahead of time that their banks will go bust. And they cashed out. They did not tell the depositors. They did not tell the investors. And look what's happening right now. And of course, as we've seen back in the GFC, these crooks will walk away with this crime. They're not going to be punished. They're not going to go to jail. None of that's going to happen. But maybe if you go to the bank branch and you throw a fit, I want my money back, you'll go to jail. Not these people, though. Listen to this. Mark Herbert, the First Republic Executive Chairman, sold $4.5 million worth of shares in January and February, in two sales worth 7% and 5% of his holdings at the time. Robert Thornton, the bank's president of private wealth management, executed the largest single trade in terms of value and proportion of holdings over the past few months. On January 18th, Mr. Thornton sold 73% of his outstanding shares in the bank for $3.5 million, and this was his first trade since 21. Other executives made sizable sales that were smaller proportions of their total holdings. All of the executives received new shares during the period. First Republic Bank Chief Executive Officer Michael Roffler sold nearly $1 million in January. The sale and another of $1.3 million worth of shares sold in November were his first since July 21, and the largest proportionally of his holdings since 2017. The bank chief credit officer, David Leckman, sold $2.5 million worth of shares over 3 sales in 23. The last came on March 6. Wow. 2 days before Silvergate Bank closed and Silicon Valley Bank disclosed a $1.8 billion loss that triggered its bank run. Mr. Leckman and his spouse had already sold $2.5 million in November and December. Their 7 trades over 5 months was the most sales they made in such time period, according to the filing. Listen to this. None of the filings for the executive sales indicate that they were executed under 10b5-1 plans, which are pre-scheduled sales designed to insulate insiders from accusations of trading on non-public information. In other words, they sold because they knew that their bank is going bust. We're supposed to stop the fight against inflation because of that? Unbelievable. And this is the same phenomenon that happened with FTX and Sam Bankrupt fraud. We now know that FTX transferred, listen to this, $2.2 billion to bankrupt fraud via related entities. Ladies and gentlemen, this is the golden age of fraud. When the asset bubble took place, fraud was rampant, and now we're finding out all about it. This is a rigged economy, and then they blackmail all of us. Oh, you can't fight inflation. You have to live with inflation. You have to live with higher gas prices. You have to live with insane grocery bills, with insane utility bills. Otherwise, some bank employees might get fired. Otherwise, depositors might lose their money. Well, what about the executives who got away with the crime? How about we hold them responsible, lock their asses in jail, take all of their money, and hand it out to the employees, the depositors, and leave the taxpayer alone? But folks, we go back to the hubris part. This is the coked up mentality. The stock market sees this chaos, bank after bank after bank collapsing, and says, wow, maybe now the economy is weakening. We have an economy that is collapsing as we speak. How could the Fed raise rates right now? The Fed will have to pause the fight against inflation, and this is going to be good for the stock market. And the rebuttal is, if your assumption is right and the economy is in a recession and it is falling apart, therefore the Fed is going to stop and this will push equity prices higher. Have you forgotten about the recession part that you're basing your assumptions on? Where will corporate profits, where will corporate revenues and earnings come from if you say that the economy is collapsing? Because a collapse in the economy means that consumer purchasing power will go kaput. A lot of people will end up losing their jobs. Even in the past, when fundamentals didn't matter, quote unquote, we did not have the risk of a recession. We still had a consumer who was spending. We still had expansion revenues. Forget about profits. We're not even asking about that. Can you say with a straight face that we're going to see corporate revenues expanding as the economy collapses? Somehow the Fed backing off will make up for all of that? And then they go and say, you know what? Forget about that argument. It is stupid. We admit. How about this? How about this new one? Yes, we have bank failures here and there, but this is not a big deal. This is not 2008. You might have heard this argument over and over on TV today. This is not 2008. Banks are in a better position. These are isolated incidents. These are banks that took a lot of risk and they're blowing up. But the rest of the economy is fine. The rest of the market is fine. And I say if this is not 2008, then why are you against the Fed raising rates? Because according to you, the economy is great. Other banks are doing okay. This is not 2008. If it is not, then the Fed should raise rates and not pause the fight against inflation. Now you don't know how to answer that because you know that your arguments are bullshit. And I say that the latest rally that we've been seeing so far gives Jerome Powell and the Fed the cushion needed to not just do the 25 basis points, but stick to the 50 basis points. Of course, they're not going to do that. Chicken Powell's not going to do it. But if market participants were actually smart and they wanted a pause, then what they should have done instead is head to the next FOMC meeting battered, bruised, the stock market down 600, 700 points. Fear is all over the street. Panic is all over the economy. Then the Fed will say, okay, maybe we should pause, and we will pause. But you morons, when you FOMO and you head into the FOMC bloated, rallying 5, 6%, certain stocks, believe it or not, up 10% plus. This week alone, Bitcoin is up over what, 20% this week alone? You're only giving the Fed the reason to say, okay, we have the cushion needed to do the 25, if not more. You think Christine Lagarde would have done the 50 had the DAX wasn't almost at all-time highs? The FTSE, the rally in the stock market gave her the cushion to do the 50. And the rally we're seeing right now gives the Fed the cushion needed to go with the 50. So the Fed has no excuse, but they're not going to do it. They're going to do the 25 instead. But again, this is not what the market wants. This is not what the market is betting on. The market rally is betting on a pause. But because of the rally, the pause is not going to happen. This is the coked up, distorted mentality. And it's going to take a shock and awe to wash the market out of this coked up mentality. Until then, folks, we have to talk about it since we're talking about the market right now. Let's see how the indices closed, and here we go. The Dow Industrial Average up by 371.98 points, or a gain of 1.17%. The Nasdaq leading the pack with gains of 283.22 points, or 2.48%. The S&P also closing in the green by 68.35 points, or a gain of 1.76%. When we look at the sectors all in all, pretty much everything is in the green with the exception of real estate, but coming up number 1, capturing the gold medal, communication services, aka Google and Meta. And at number 2, technology for the silver, silver, aka Microsoft, Nvidia, AMD, Apple. And at number 3 for the bronze, consumer cyclicals. And notice that energy participated in the rally today, so all of that assumption from yesterday that we have a recession theme, you gotta be careful of these assumptions. The market is gonna flip-flop from theme to theme to theme until we get clarity from the Fed. When we look at the breadth, the NYSE 74% advancing versus 25% declining. The NASDAQ 64% advancing versus 33% declining. Now you might say, hey, Maverick, it was a huge rally in the NASDAQ. How come it's just 64% positive? Because the majority of the rally was led by the big caps. When we look at commodities, the dollar was flattish for the day. Went up, it went down, but it closed pretty much flattish. And guess what? Gold, the old man, also closed flattish. So we have no guideline at all here. And absent of a guideline and recession fears subsiding with all of these bailouts, we see energy blasting higher. We have nice rebounds across the board. The WTI and Brent all closing with gains north of 1%. The gasoline RBOB futures up by more than 2.5%. Heating oil up by more than 1.5%. And then even natural gas up by more than 3.5% today. Softs, green across the board. Cocoa, OJ, coffee, lumber, sugar futures, all in the green. The exception is cotton, slightly down. When it comes to metals, we talked about gold and silver down. Palladium was also down by about 1.75%, but we have platinum and copper rebounding by about 1% apiece. Meats, green across the board. The exception is lean hogs, down about 5%, but it is a different contract, so the losses are amplified because of that. When it comes to grains, muted reactions across the board. The most notable movers, soybean meal, down about 1% for the day. On the other hand, soybean oil, scoring gains north of 2.25% today. All in all, we get assumptions that the Fed is about to back off. What happens to the recession theme? It gets off the table, and therefore gold is underperforming today. What's outperforming? Oil, gas, gasoline. So be careful what you wish for. If you say, oh, we have a lot of damage in the economy because of these banks, and the Fed has to back off, if the Fed does that, you will see a massive rebound in commodities, led by energy. Energy only went down because of the assumption that we have a recession in the economy. But if the recession theme is no longer in play, we will see a massive rebound in energy, and therefore it could be a buying opportunity in names such as Exxon, Hess, Halliburton, names that went down big. But folks, it is too early to assume anything right now because we have no idea which theme will stick by the end of the day. If we know for sure it's going to be inflationary, then yes, the dip should be bought in Exxon, Halliburton, but the safest way you can do it right now is by buying call options until we know for sure which theme the market will settle in. Moving on to the big casino, the options market, what do we see here? The volume is up across the board because we have, the Fed is backing off, crisis averted, buy. Yields are going down, and the valuations don't matter anymore. And therefore, we see the hottest stable by far, Tesla, the souffle, with around 2 million contracts traded today. About 54% of those were calls. Amazon at number 2, with around 1.2 million contracts traded today. About 65% of those were calls. And Nvidia at number 3, with around 1.2 million contracts, although in this case, puts outweighing calls with about 52.5%. Now, a lot of you keep asking the same question. Hey, Maverick, when will Nvidia go down? I say when you give up. You know why? Put yourself in the shoes of the market maker right now. The retail mom and pops are stampeding buying Nvidia puts, but they buy way out of the money with shorter expiration. Let's say that the stock right now is trading at $255. The mom and pop are buying the 200 puts for the expiration of this Friday or next Friday. Now, again, put yourself in the shoes of the market maker. Would you respond to that feedback at all? Somebody's buying the 200 puts way out of the money? Hey, maybe you noticed that, but you're not going to make any moves based on that. On the other hand, the buyers of calls, and a lot of them are institutionals, by the way, what they do is buy huge volumes near the money or at the money exactly for also near expiration dates. Now, again, as the market maker, the dealer, which feedback are you going to respond to? Call options buyers who are buying near the money with shorter expiration, so they're buying the 260 and then they're rolling to the 275, etc., etc. Or the mom and pops buying puts all the way down at 220, 200. I think the answer is clear. And until this balance changes, the market maker has no incentive at all to dump shares right now. But you know what the market maker is incentivized to dump tomorrow? Because we have options expiration, so we have the phenomenon of max pain. And in a nutshell, max pain means the dealer wants to close the underlying security buy the underlying ticker, whatever ticker it is, at the point that makes sure that the majority of call options holders and the majority of put options holders end up losing their money, meaning their contracts expire worthless. We'll look at the Qs, which is the most important ticker to watch in tomorrow's activities because it has been the leader, but my hunch is it will start to lag. And the SPY, but especially the IWM, will close the performance gap with the Qs. In any case, these are the contracts with the expiration date of tomorrow. Look at the open interest. Forget about the volume. The volume comes in and goes out. But the open interest are the contracts that are being held right now. Anything that you see shaded in the green, that means it is in the money, meaning the dealer is obligated to deliver for these calls if they expire in the money. Look at the open interest. Any contract with very extreme large value, the market maker wants to make sure that the majority of these contracts are going to expire worthless. The highest one is the 310. It has about over 90,000 contracts open right now, but it is out of the money. So far, so good for the dealer. But then they have the 305 with about 70,000 contracts open. Now, the dealer wants to make sure that the majority of these contract holders will lose their money. So they have to move the Qs below 305 and close the day below 305 to make sure that that will happen. Then they got another problem. The 300 call, also in the money, with about 80,000 contracts open. The dealer wants them to lose money too. He does not want to deliver in a loss. So they're going to try to move the Qs all the way down to 300. But there was another catch. We also got put option holders. When we look at that, look at the open interest. The highest one right now is 305, but that's about 50,000 contracts. The dealer would rather make sure that the 70,000 plus contracts open for the calls will expire worthless, and then they'll deal with the 50,000 open for puts. They move the market down, then they move it up again to make sure that the majority will lose their money. The problem for the dealer is if they go below 300, then he got over 77,000 contracts for the puts open at the 300 level. The dealer doesn't want to lose that money by closing below 300. So what they're going to do is they're going to try to move the Qs all the way as close as they can to 300 and see what happens. If the call options, put option holders start to panic and close and they get rid of the majority of call options holders, then around midday, 10:30 Pacific time, they're going to move it higher again to make sure that the put options contract holders will lose their money too. That is called maximum pain. But with that out of the way, let's move to the unusual activities that took place in the casino today. We begin with the ticker BAC for Bank of America. Now, it did not close above my numbers, so we're not buying calls in the name. A matter of fact, we have somebody who's buying puts here, big time. They bought the 22 puts for the expiration date, May 19th, with expectations. This is a big one. The BAC will go down by more than 24% by the expiration date. What are they seeing here? They paid around 40 cents a piece. Enter this trade, all in all, spending around $2.5 million. And then what about the SPY for the S&P 500? Somebody's buying puts here, fading the rip, and they did buy the 315 contract, the expiration date, April 28, with expectations that the SPY will go down and lose more than 20% of its value by then, which also means that this trade could be a hedge. They paid around 55 cents a piece to enter this trade, all in all, spending around $2 million. And then we have AMD, a decent outperformer as of late, but somebody is fading the rip by buying the $90 puts for the expiration date, March 24th, with expectations that the name will go down and lose more than 7% of its value by then. They paid around $1 a piece to enter this trade, all in all, spending around $1 million. Last but not least, what about the ticker GM for GM? Somebody sees the name moving higher and they they bought the 37 calls, the expiration date, May 19th, with expectations that GM could move higher and gain more than 7% by then. They paid around $1.55 a piece to enter this trade, all in all, spending around $1.5 million. On to the heat map. What do we see here? Any theme? The theme is clear. Risk on, no risk off, as we've seen in yesterday's session. Therefore, trading is really confusing right now. You gotta be really careful. Risk on means technology is outperforming, not just the big caps, but also software, semiconductors, the high beta profitless names leading the pack. We see cyclicals rebounding higher, casinos, hotels, airlines, industrials are moving higher, retail moving higher, biotech moving higher, even the inflationary theme, energy, metals, all moving higher. Banks caught a rebound. Now, what are the laggards? Among banks, Charles Schwab, this is really really concerning. The CEO says that he bought 50,000 shares. I don't know if he's pumping and dumping, but this is really concerning. On a day where banks are up, Schwab is down. We see Big Pharma down too. These are the kind of value/dividend paying names that shine in the recession theme, and they did in yesterday's session because it was a recession theme. Today, they're actually moving down. And the same goes for utilities. We have some gains, but we have a lot of laggards. Real estate is down. Consumer defensives are down. The telecom high dividend paying names are down too. T-Mobile, Verizon. So yesterday, the thinking was we have a recession coming. We're seeing bank after bank failing, and we're not sure what the Fed is going to do. So we're going to stick with the big caps. That's considered safety in the meantime. We're going to stick with the recession theme, the high dividend paying names, which also happen to be value, in big pharma, in utilities, some REITs, and consumer defensives. Also names such as McDonald's and Verizon tend to shine under that theme. Today, the market says, okay, we're sure now that the Fed will pause. I don't know why they believe that. And therefore, we have to buy risk on, regardless of the valuations. We're going to dump the defensive names, high dividend, who cares? We don't want that anymore. We want growth because yields are going to move down. The Fed will pause growth at any cost. We're back at the expansion theme. This is the thinking for now. Keyword for now. We will look at the heat map for the ETFs. Again, the dollar did not move one way or the other. Yields were slightly higher, so bonds were down, and therefore the rush to safety is no longer needed. Bonds down, gold down. We're seeing more exposure to risk on. Technology, XLK outperforming. Chips, SMH up 4% or so, big time. Even the small caps caught a rebound. Growth outperformed value. Rebound in financials based on the news of the rescue operation. But who knows if that's going to hold or not in tomorrow's session because First Republic Bank is down big after hours. But also energy caught a bid. XOP, XLE, OIH, all closing positive. The cyclicals, the retail names, XRT, XLY, all caught a bid today. So we have a mix between the expansion and the inflation theme this time around. No love for the recession theme, at least today. And folks, until further clarity from the Fed and until the market makes up its mind on which theme it wants to follow, all of these moves, be it up or down, cannot be trusted. So a lot of you say, Maverick, should we dump energy right now? Maybe not. Maybe it was a fake theme yesterday. And energy is going to rebound higher again. We'll talk more about that in the charts analysis. And speaking of, let's do some charts. And we begin with SPY, the S&P 500, 30 minutes chart. What do we see here? I forgot to remove these comments right there, but this is part of my morning brief to the members of this channel. We talked about support and resistance. The most important resistance was at the time 393.58. And if we do have a break above, then we're going to go ahead and buy 400 calls on the SPY. You can buy them for the same day and close them by the end. You can buy them for tomorrow's expiration. You can buy them for next week. Doesn't matter to me. The point being is, once an important resistance is broken, the algos will start to buy. And therefore, this is your play to be in the long side. On the other hand, if the most important support is broken, which was at the time and remains, by the way, 385, then we're going to go ahead and buy the 375 puts. Of course, the bullish scenario took place. We have a break above 393.58, and now we're eyeing 398. I told you guys, if we have a rally back when we were all the way down at around 385, I told you guys if we have a relief rally, we can go all the way from these oversold conditions back on the 10th. We can move all the way to 390, 393.58, but 398 is a long shot. That's going to be a stiff resistance. It's going to require more than false assumptions to pass above. In other words, we're getting close to the end of this move. And you look at the hour side, it is getting a little bit overextended, not as much as the Qs, as you'll see in a minute. Now, when we look at the daily chart for the continuous contract, the SPY, what do we see here? Number one, and the most important development, is a closing above 3,960. That is bullish, not bearish. But we have 1 day left for the week. If the chart closes above by the end of the week, that's bullish, not bearish. Closing below, the bears go back at it. The volume is moving higher on buying today. That's a good sign for the bulls. The RSI is reversing negative divergence and accelerating higher. The MACD indicator is doing the same. These are all good signs for the bulls that they can run high and retest 4,000 as the next resistance. When we look at the SPX, the cash index, an hourly chart, what do we see here? We got the pump today, but I want you to notice the RSI. On the hourly chart, the RSI is not overbought, as you will see with the Qs, and therefore Therefore, my hunch is maybe we will see the SPY closing the performance gap with the Qs. The Qs lags, and then we see the SPY outperforming. That is the assumption for now. No guarantees, of course. In tomorrow's session, the most impactful event will be options expiration, what the market maker, aka the dealer, will do. In the meantime, we're above the 200 days moving average, meaning the quant funds bought right away. They will continue to buy, but we have more tests to come if the chart continues to move higher. Number one, we have 3,970. Number two, we have 4,000. 4,000 will be a long shot. You need something more than, oh, the Fed is going to pause to get above 4,000 again. You need a fundamental piece of news. And here it is, the Q's an hourly chart. This is what I shared on Discord. I told you guys that look at the hourly chart. Stop chasing trades right now. Wait till we have a swing trade. Save your money for that. Watch the hourly RSI. Every time we got at a hot reading above 70, we got a pullback. So you want to play that. You don't want to play the 1 minute chart because you're going to lose money all in all. And here's what happened. I gave you a number, 306.70. Here it is, the update. We're getting there. We got to the RSI above 70. We got above 306.70. The closing was 306.80, excuse me. The risk versus reward says, with such overextended reading on the RSI and with the dealer wanting to induce maximum pain, we will see a pullback in the Qs tomorrow. Is it going to go all the way down to 300? Perhaps. But the base assumption should be a pullback in the Qs. Here is the daily chart for the continuous contract for the Nasdaq. Big positive candle for the day, not only crossing above 12,339 as resistance, but above the upper channel in the megaphone pattern. And now we're eyeing 12,766. Whether that's going to happen or not, you got the conflict between the hourly chart, which is way overextended. The dealer wants to push the chart down tomorrow. And then you got the daily chart with plenty of room to go if this rally wants to continue. For one thing, the volume is moving higher on up days. That's a good sign for the bulls, at least for today. The RSI is reversing, producing a pop higher, reversing the negative divergence. We also have the MACD indicator crossing and producing positive impressions on the histogram, indicating bullish momentum ahead. But we have 1 day left for the week. Can we close the week like this, or are we going to see a nasty last-minute reversal that takes us below 12,339 or back into the megaphone pattern? If that is the case, then we might have the risk of a sell-off ahead of the FOMC or aftermath the FOMC. When we look at the IWM, the underperformer for the week, and as of late, because of the exposure to regional banks, this is an hourly chart. We're now above the resistance, now support 174.22. We have a consolidation in a bull flag pattern. The assumption should be the IWM can make it, has the conditions to make it all the way to 180.54. The problem is, what if we continue to see weakness in regional banks? What will the market maker do in these stocks? In FRC, Bank of America, JPM, Schwab, all of them are down big. My assumption is the market maker wants to make sure that all of these puts that are in the money right now will expire worthless. But what if we have more selling pressure because we have some news? The bailout of FRC didn't take place. The bank instead blew up. Then we could see the IWM moving down again. But technically speaking, this look that we see right now is bullish, not bearish. What about the Dixie, the dollar index? What do we see here in the daily chart? Consolidating, not a major move here. Eating away time, waiting for the FOMC. For now, we have weakness in the momentum, and therefore, we see the chart consolidating. The problem is when we look at the weekly chart, look at this. You look at the MACD and the consolidation of the Dixie. It appears that the dollar is just eating away time, waiting for the FOMC to do what? To pop significantly higher. We see it crossing in the weekly MACD indicator, producing green impressions in the histogram. Now, think about it. Why would the dollar pop significantly higher? The answer is the Fed coming out with a hawkish surprise. Could it be 50 instead of 25? Could it be 25 but with extra mean talk by Powell? That could be the case. And if the dollar moves higher, equities are not going to like that. What about gold? The old man, what do we see here? It is at the resistance of 1928, but is it going to make it? Is it not going to make it? That depends on the dollar. My hunch is gold rallied based on the assumption that we have a recession theme ongoing. Now, what if this is a false assumption? We freaked out, we panicked because we have a bunch of banks blowing up, and we said, okay, yields went down big, crashing. So we assumed that we are in the recession theme. We bought gold, we bought bonds, we dumped oil. But what if we found out in the next few days that things are stabilizing in banks, and now the focus is back into the Fed's policy and inflation? If that is the case, dollar is going to rebound, and we're going to see bonds and gold being dumped along with equities. And in that case, the old man will go below 1895. and maybe all the way down to 1842 once again. So we're not in a rush here to buy gold. We're going to have plenty of opportunity. Once it is clear that we have a recession theme, you're going to have a beautiful opportunity to accumulate gold. I'm not in a rush right now. And here is Brent oil, a daily chart. We're below 77. We have 1 day left for the week. The most common question that I get, besides Bank of America calls or Nvidia puts or what's going on with the market, Maverick, they're going higher again, is should we sell oil? Is it time? The answer is I'm not sure. The answer is the chart says yes. The action in energy stocks says yes. But again, what if we freaked out and moved prematurely into the recession theme? In the meantime, we should have stuck with the inflation theme because the crisis in banks is stabilizing and the focus right now on the Fed policy. You got to think about that. But for now, the weekly chart doesn't look good until and unless we see oil rallying higher significantly in tomorrow's session above 77 and reversing the curling down in the MACD. You see that little red impression in the histogram? If it turns green again by the end of the week, then oil is still alive. What about the 10-year yield? What do we see here in the daily chart? Again, the assumption the moment we heard about SVB collapsing and all of that is okay, the economy is collapsing, the Fed perhaps done too much or maybe didn't do too much. It's just these are the casualties of Fed tightening. And the Fed will have to pause because the recession is intensifying. I think this is a premature argument right now, but what do I know? The market spoke already. We saw yields crashing like we've never seen before, indicating that we have a recession theme. But lately, at least today, we saw a rally in the 10-year, indicating the possibility that we could revert back into the inflation theme. We see the 10-year blasting higher all the way back to 4%. That is entirely possible, folks. Therefore, when the commentator says it is chaos, it is indeed chaos. For now, what we know, we're above 3.5. If we close above 3.5, then the possibility of going all the way back to 3.8 and then 4 is highly likely. As we get closer to the FOMC, by the way, you're going to see the odds for 25 and maybe the odds for 50 catching a bit. Maybe you'll see the odds for 50 at 5, 8, 10%. A lot of reckoning will take place. Another one, the TLT daily chart. In a recession theme, you buy the TLT. In an inflation theme, you short the TLT. Look at the chaos that's going on. Up and down, up and down, up and down. Why are we seeing this? Indecisiveness, confusion all over the place. So for now, can you do anything with this chart? Absolutely not. The action by the Fed will resolve all of this, but this is not coming until next week. In the meantime, VIX 4 hours chart, what do we see here? In negative momentum in the RSI and the MACD indicators. Below the important support, now resistance at around 24.29. Could we go all the way down to 20? If that is the case, the SPY will rally all the way till the FOMC. But the strength right now in the weekly chart of the VIX says sooner or later, the VIX is going to pop. By sooner or later, I don't mean October. I mean in the next few weeks, March, April at the most, we will see VIX moving significantly higher, above 30s. Gee, how would that happen? How about a crash in the SPY? But we'll take it one step at a time. What about Apple, the big kahuna 30 minutes chart? What do we see here? You know, we have a member on Discord who kept saying, hey folks, the double top on the SPY, watch out, double top, double top, double top. Nobody wanted to listen, but what he's referring to is, look at this, Apple, 30 minutes. We're back at the same top, which I believe stands at 155, 70 something. Let's say 156. And the RSI is getting overbought, quote unquote. Wouldn't it be a good time for a pullback and hence the double top? If that is the case, we got support at 154.60. But if we have a double top, that support is not going to hold. We're going to go back sooner or later all the way back to 152.3 or 03, I should say. I mean, it doesn't matter. 152. Let's just call it that. And then eventually, we're going to go back to 150. 150 is not going to hold. And here we go back to 145. We're just playing this little game right now of, oh, Apple is safety. We're kind of concerned. We're afraid. But we're also buying RKK. We're also buying Roku. We're also buying Carvana and Peloton. But we're also looking for the safety in Apple. You can't have it both ways, folks. And then we have Tesla, the souffle, an hourly chart. Believe it or not, while we have a rally all in all, Tesla kind of underperforming here. This is what happens when a mechanical rally, such as the massive mechanical rally we've seen in Tesla shares year to date. When a mechanical rally dies, it is really hard to revive it because everybody who wanted to buy Tesla is already in. The market maker already bought an insane amount of shares. So it's going to take huge volume, huge amount of new blood buying Tesla calls for the shares to move higher. Now, you put 2 and 2 together, it doesn't matter how high it goes. Maybe we have a bull flag consolidation pattern for now. It pops higher, fills the gap at 187.68, even moves all the way higher to 194.55. Sooner or later, the balance of power says when these holders realize that, okay, this thing is not moving, on the other hand, stock so-and-so is moving. I'm missing out here. Maybe Tesla tapped out and they start selling. Folks start to pile in, buying puts. The dealer gets the feedback and start dumping shares. The balance in power in Tesla shares is on the side of bears, on the side of more downside coming. And by the way, we have another mechanical rally in NVIDIA. Once that breaks, it's going to look exactly like Tesla, and it's going to be really hard to revive the rally back in NVIDIA. Last but not least, what about Bitcoin? Tulips, the daily chart, what do we see here? For now, after getting rejected from 26,555, it is consolidating. Bitcoin is asking, hey, we need more buyers to crack above that tough resistance that we just got rejected from. Any buyers? Anybody waiting to buy tulips right now? The chart is taking time, taking a break, giving you the opportunity to hop in. If the buyers don't show up, if the buyers say, no thanks, would rather buy equities or would rather go to the sidelines, or maybe, hey, we have Jerome Powell coming, maybe we should move back to risk off, then the sellers are going to show up. The sellers are going to say, okay, we made enough money in a short amount of time. No buyers are showing up. Let's just dump and move on. And then Bitcoin goes down. So for now, the psychology is supreme in this chart. It is an invitation for buyers to show up, and if they don't, the sellers are going to make decisions here. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We begin with industrial production, and then we have capacity utilization, but most importantly, leading economic indicators and consumer sentiment. With that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again over the weekend, but I have a feeling that I'm going to have to talk to you on Friday instead, meaning tomorrow, because something will happen. Once again, we'll take it one step at a time, but for now, this is all I got for you. Thank you once again, and good night.
We've been handed an incredible opportunity here, Beck. The universe is talking to us right now. You just gotta listen.